Hello and welcome to Upstack America's Oracle EBS Financials Functional Training. My name is Bob and I'm the lead senior consultant for Upstack America. And with me today I have Victor, who is also a senior consultant. And today we are handling lesson 10 of the fixed assets module. And Victor, please walk us through.
Thank you, Bob, for the introduction and welcome everybody to this lesson in our Financials Functional Training series. Like Bob said, we are on our 10th lesson of FA, and we are still looking at our setup steps before we can have a functional module, and we are dealing with our book controls. So just a reminder of where our book controls fall in our great setup plan. We are on this third step. We need to define some book controls for our corporate book, okay? And then after that, we can start creating categories and adding assets to our corporate book. So some of the things that we need to set up in the book controls, we have talked about this many times. We have calendars. We also have some accounting rules, and we have some natural accounts. We talked about the calendar, which included some of the fields you're seeing here. We had to enter the prorate. We had to create a prorate calendar. We had to create a prorate convention. We had to create our fiscal year. We also had to create a depreciation calendar. We already have a ledger. So we should be set for our calendars in the book controls. The other thing we need to have are these natural accounts that are used in some of the transactions in FA. The first bunch of accounts, you can see the proceeds of sale, cost of removal, revolve reserve. Those ones are used in retirement of assets, okay? And we have some accounts here, depreciation, reserve, and deferred depreciation expense. That's another group of accounts that we'll need to talk about and create, which are important in the process of depreciation. So we had already started talking about the first group of accounts, which are important in the process of retirement. And the way we did that is by looking at accounting examples, okay, of how accounting would be created in the case whereby you have purchased an asset and then you want also to retire the asset. And you can have various scenarios whereby you're selling the asset when you retire it, so you have some cash proceeds, or you have to pay for the asset to be disposed or removed. Maybe it requires some special expertise and you pay a company to come and remove that asset. So you have cost of removal. And we also talked about the concept of gain and loss, which can accrue from any of those two process and also from book value loss, okay? So in our previous sessions, we looked at that accounting in what I said was like its final form, a combination of all the accounting entries that would be created from the different modules involved. We said, for example, in asset acquisition, AP will have to be involved because you're making a purchase of that asset, okay? So there will be some payments and some invoices involved there before you can go and add your asset to your corporate book in FA. If you're going to retire an asset, there are various reasons why you're retiring these assets. It could have been fully depreciated and come to the end of its useful life, so you're just disposing it. It could have been stolen, all right? So when it's stolen, it is off your books, so you have to retire it. And if it's not been fully depreciated, then there will be some loss incurred there. You could be selling that particular asset because it has come to its end of useful life for you, and in that case you'll be receiving some money, so accounts receivable will have to be involved there because that's a sales transaction, right? If you're paying for this asset to be removed or disposed, like we have said, maybe it requires special expertise to be removed, then AP again will have to be involved there because you're purchasing a service, correct? The removal. So that's what we want to look at today. In our previous session, we looked at, the combination of all those transactions and what accounting they would give us, and that was for the reason of understanding where gain and loss comes in, and also where those particular accounts come in, the proceeds of sale and cost of removal. So now we are going to look at those transactions per module, with each of the modules that would be involved. And we are going to start with acquiring an asset. So to acquire an asset, first you'll have to purchase that asset, right? And AP will have to be involved because that's the purchase ledger, the purchases ledger. So if you're acquiring an asset, for example, for $100, this is what would happen. You would have an asset clearing account, okay? Asset clearing account is the account that you would use and debit. It is an asset type account, okay? And then this is the invoice you would get, let's say that, from the person who you're purchasing the asset for, and this is the invoice accounting that would be created. So you'd be liable for $100. Let's say we're using dollars, so our payables account would be affected, and the asset clearing account would also be affected. So we haven't mentioned asset clearing before. This is the first time we're mentioning it, and we are going to see like what role it plays. And then, of course, you would make your payment for the asset after receiving the invoice. You'd make the payment for the asset, which means you would reduce your liabilities and debit your payables for the same amount, all right, and pay cash, okay? So you're crediting your cash because our cash is an asset account as indicated here. When you're reducing it, you're crediting it. So up to that point, we have 3 different accounts involved. Remember, these are AP transactions. So we have this asset clearing, we have payables, and we have cash. In this page, already you can see that payables has sort of canceled each other, right? So this is a credit of 100, and this is a debit of 100. So those clear out, and you're left with asset clearing and cash. So you go to the next step. You have purchased your asset. Now it's ready to be added to your corporate book, so you can start managing this asset for depreciation or any other transactions that will take place within its useful life. So when you add your asset, and I can see a mistake in this slide. So when you add your asset, you are supposed to debit asset costs, all right? Not asset clearing. So bear with me on that one. So this is supposed to be asset cost. I think I copied this table and forgot to change the values. So this is supposed to be asset cost, which you're debiting. So that's where asset cost comes into play for the first time. And you're supposed to be crediting assets clearing, okay, for the asset addition process. So this slide has a problem. Let's see whether we can make any changes. All right, so I made changes to the slide. So this is what it's supposed to be. If we go back from here, This is where we started with the purchase, and then after we've made the purchase, we add the asset to our corporate book, and this is the accounting that would be created. So the asset has been added to our books. Now this is the asset cost account. When you're adding an asset, it's a debit. That's the natural balance, right? Debit balance is a positive balance for asset. So that will be debited, and then this asset clearing will be credited. So remember we had asset clearing here. Here we cancelled out payables. Okay, we were left with asset clearing and cash. Here we have added asset cost, and then we have credited asset clearing. So we have cancelled out the asset clearing also from here, because this was a debit and this is a credit, so those have cancelled out in terms of the balance, right? So what we are left with is asset cost and cash, which is basically the whole net transaction we were talking about in our previous session, right? So you have added the asset, debit, and you have paid cash for it. That's the final representation of that transaction, from asset purchase to when it was added to your books. Okay, so here is what we have done. Asset cost is debited when asset is added in FA, and the asset clearing account is used as the link between AP and FA. And the reason why we are saying that is because this is our first entry in FA when we add that asset, and the account we are using is asset clearing. We could have just said, well, we paid cash for this, so let's credit cash and have this as our accounting. But that's not what happened, because first, as you have seen, we don't have any cash account setups in FA, so we can't affect cash in FA. We can't touch the cash account in FA, but you can do that in AP and AR. But in FA, as you have seen, there's nowhere where we are touching the cash account. So the asset clearing account is used as the link between FA and AP. So this is the net. This is the net of the transactions involved in asset acquisition from the purchase up to when it's added to FA. Now, after it's been added, you can start calculating depreciation expenses for it. Okay, so that's our asset acquisition. Let's go to retirement. As we have said, retirement means we are taking it off our books. We can retire it in various ways, or retirement can be because of various purposes. One, we have fully expensed out this asset. It's no longer useful to us. We are disposing it. It could be stolen. Maybe we are retiring it and we are selling it also. Okay, it could be lost, could be damaged beyond repair. All those are reasons why you might retire an asset. So to retire an asset, in the case whereby you're selling it, AR would have to be involved, right? Because that's a sale you're making, so there's a customer involved who is purchasing that asset, and he's going to have to pay you. So once you have put your asset on the market and you found a buyer, all right, then you will send an invoice to them, okay, telling them this is the invoice for this particular asset. Let's say you're selling them a car or vehicle, your company vehicle, which you're not using anymore. So when you create that transaction, it's called a transaction in AR. This is the accounting that would be created. So you're expecting this person to pay you, all right? So you have receivables. That's an asset account. So you're increasing that. Let's say you're selling it for $20. and then you will credit this proceeds of sale clearing. Okay, and this proceeds of sale clearing, we will see, acts the same way as the asset clearing account, as a link between AR and AP in this case, and FA in this case. So it's a revenue account. You credit it because you're increasing your revenue. You're expecting to get some money from this guy. So when the person you're selling this vehicle pays you, that's a receipt, right? So you debit your cash and you credit your receivables. Okay, so you no longer have any receivables because they have paid you. So receivables cancels out here, right? So you're left with proceeds of sale, clearing, and cash, which you received from the sale. So remember, we are selling this asset, which means it's coming off our books, which means we are retiring it. So what would happen in FA when you do this retirement? First, we are assuming that this vehicle has been fully depreciated, so there's no book value loss, but we are going to sell it for a particular amount anyway. Just because your asset has been fully depreciated in your books based on that, whatever information, the depreciation method and the useful life entered there, doesn't mean it does not have a value in the real world, in the market. And that's why it's called book value, whatever is calculated by your books, right? So your books might say that this asset has been completely expensed and it has no value, but you could still sell it in the real world. Anyway, so you're selling this asset, which we are saying is a car. It's fully depreciated, but you're still selling it for this amount, okay, $20. And this $20 is going to be recognized as a what? As a gain. We talked about this gain and loss concept in our previous session, okay? So in this case, our gain is equals to what? Gain is equals to negative of book value plus the proceeds of sale. Okay, so book value here is 0 because this asset has been fully depreciated. So 100 minus 100 is 0, but we are selling it and we are getting $20 for it. These two are revenue accounts. So the gain account is being credited and the proceeds of sale account is being debited. So this is where the proceeds of sale account becomes the link between FA and AR. So here we are debiting it as a revenue account, meaning we are reducing the balance. And here, remember, it was a credit. So these two cancel each other, all right? So this proceeds of sale and this proceeds of sale, they cancel each other, all right? So now up to that point, we have been left with cash. Receivables cancel each other. So we've been left with cash and these three: accumulated depreciation, asset cost, and gain and loss. And therefore, our final accounting will involve those accounts, which is what I showed you in our previous session. Okay, so accumulated depreciation, cash. This is the reason why I was calling these accounts like cash proceeds, although it was the actual cash account, because I just wanted to indicate where this is coming from. It's the proceeds of sale. But anyway, this is the cash account because you received cash for selling that asset. And then you have the gain from those sales. It's a gain because according to your books, this thing shouldn't have a value, right? But you're still selling it for some value here. So that's why it's a gain. And again, proceeds of sale is the link between AR and FA. A lot of mistakes in my slides in this session. So this should be FA. Proceeds of sale account is the link between AR and FA. We also talked about cost of removal. So let's see the accounting. Cost of removal, AP will be involved because you're paying somebody for these services to remove this asset. Okay, so maybe it's a machine and there's nobody in your company who has the expertise of removing that machine and disposing it. So maybe the original manufacturer or somebody or another company that specializes in that will come and take care of it and go and dispose it. So you'll have to pay them, right? So they'll send you an invoice, okay, for the cost of removal once they've removed it. And that is an expense account, this cost of removal clearing. So you debit your expense, meaning you have incurred an expense and you are liable for that amount, $10. So your payables also go up, which is a credit. Once you make the payment, you reduce your payables by debiting it and you pay out cash because you're paying for that service in the payment. So in this first instance in AP, payables is already out of the picture, cancel each other, all right? So you're left with cost of removal, clearing, and cash. Cost of removal, of course, it means it's a retirement that's taking place in FA because you're removing this asset and therefore you're taking it off your books. Let us assume in this case we're just retiring the asset and disposing it. There's no selling it or it wasn't stolen or anything, so it's fully depreciated and we are getting rid of it, but we still have to pay some people to come and remove it. So asset retirement in FA with cost of removal, this is what it will look like, okay? Accumulated depreciation and asset cost, we know will have to be there, okay? Now we are getting a loss here because this is a revenue account and we are debiting it. We are debiting it, yeah. And this loss is coming from the cost of removal that we are paying, okay? Remember, this cost is associated with this asset. And since we have already expensed this asset, we are incurring another cost above that for removing it. So that's why it's a loss. And since this is a revenue account, we are debiting it to show a reduction in revenue, which means it's basically an expense, right? And of course, we are crediting our clearing account, cost of removal clearing. So the cost of removal clearing cancels out each other. This side it was a debit and here it was a credit. So those entries cancel each other and you're left with cash and these three accounts here. So the net accounting created with cost of removal for an asset retirement is this, okay? So accumulated depreciation, asset cost, loss in this case from the cost of removal, and the cash that you paid for that removal. Now, when I say the net accounting created is this, it doesn't mean that this is the only accounting that's created. These are the final balances associated with this transaction, all the way from AP to when this asset is retired. So each of these accounting entries will be created for the particular module, okay? But in the end, the total balance of those transactions will come to this. But each of these entries will be created because, of course, we want an audit trail, and that's what the software is for anyway. We want to track every aspect of the business and the transactions that the company is taking place in. So anyway, remember the reason why we are learning all this accounting stuff is so that we understand the purpose of these accounts that we are entering in our book controls. So we need to understand what they are before we enter them. We just don't want to be entering stuff without knowing what we are doing. So that is the main purpose. And now from our next session, we are going to talk about these accounts associated with depreciation. And then from there, we'll have discussed all the features for book controls that we need to fill out. And once we fill those out, we are going to have a corporate book. And then from there, we are going to create categories, and we can add assets to our corporate book and start performing transactions. Anyway, that's it for this session. Bob, unless you have something to add.
Thank you, Victor. Thank you so much.
Thank you.